In recent weeks, the speculators have been waging an all-out war on the American dollar. The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States. Now, what does this action, which is very technical, what does it mean for you? Let me lay to rest the bugaboo of what is called devaluation. If you want to buy a foreign car or take a trip abroad, market conditions may cause your dollar to buy slightly less. But if you are among the overwhelming majority of Americans who buy American-made products in America, your dollar will be worth just as much tomorrow as it is today.
Marking an anniversary can often seem like a hollow, perfunctory exercise, but I'd say this time that's definitely not the case. The 50-year anniversary of the Nixon Shock, as the policies he outlined in that speech, carry unique resonance today. We find ourselves in the last year transported to this sort of bizarro world where the Fed's balance sheet has suddenly mushroomed to almost half of GDP. Fiscal policymakers are making with multi-trillion-dollar stimulus bills seemingly on the daily, and inflation is back to levels we haven't seen since we were all sporting bell bottoms in the 1970s. So one imagines that even to the most jaded observer, the question of how long we can maintain this fiat money standard that was ushered in that Sunday evening 50 years ago really begs. The problem for most of us is it's the only monetary standard we've ever known, which is why I'm particularly pleased to be able to MC this conversation with two gentlemen who are just getting started in their investment careers when the Nixon shock happened. So without further ado, my name is Stephanie Pomboy. I'm the president of Macro Mavens, a macroeconomic research firm. And I am joined today by John Hathaway, who is the co-chief portfolio manager of Sprott Gold Fund, and Bill Strong, who is the managing partner of Eschaton, a global value hedge fund. And we are gathered here today as summer neighbors in the beautiful mountains of Colorado, albeit a little smoky right now. So we're in our Western best, or at least two of us are in our Western best. Gentlemen, thank you for being with me today.
Thank you.
I'm very excited because I was in diapers, I'll confess, when this event, this shock happened. So obviously what I know about it comes from the history books, but you guys were there, you were on the scene, you were just getting started in the business. So it surely informed your entire careers since then. But I'm curious to know, when it happened and you came to work the following Monday morning, whether you understood at the time how radically transformational the policies that were outlined in Nixon's speech would prove to be. So I'd love your just reminiscences about what strikes you the most when you look back on that time. John, if you would kick things off.
Sure. For me, I was with a firm called Spencer Trask, a white shoe brokerage firm, which I don't know if they exist anymore, but our job was to promote the most expensive stocks, desert island stocks. The idea being that if you went to a desert island and came back, your portfolio would look just fine. So if you had Polaroid, Simplicity Pattern, Kresge, and so forth, you would come back and you would be just fine. But if you actually did that, you would be broke.
Right, those companies don't exist today.
So I was blissfully unaware of what had happened at the time. I only became aware in the bear market of '74. And I started reading Austrian economics. I read Hayek, von Mises, and I got the idea that something was horribly wrong, and I became very interested in gold back in the mid-1970s. And what I remember for the rest of the decade was how unattractive to most people the idea of being in the investment business was. And people took pity on me that I was actually in the investment business. And that was the mood at the time when stocks made a huge low and bonds made a low, I guess with the onset of Volcker and his policies. So that was my fast forward experience in the 1970s.
Wow. Fascinating. What about you, Bill?
Well, I wasn't exactly in diapers, but I hadn't started to work yet either. I'm a couple of years behind John. I resurrected an old photograph, which I think is kind of fun. I don't know if you can see this. This was a photograph of me in August of 1971. I was in London on my end of my tour of Europe, which my father had given me as a graduation present. I just graduated from a liberal arts college in the East Coast. And we were traveling around, and so we were exchanging U.S. dollars for foreign currencies. And I remember the event, not for what Nixon said in the speech, but because my U.S. dollars, the last transaction I made, bought less pounds than it had the rest of the summer. I read about this in the Financial Times, but I was an econ major in college, and in those days, 60s and 70s, the East Coast liberal faculty of an econ department were very much Keynesian. And so we had a Keynesian macro perspective, which basically ignored gold completely. It was a barbaric relic, and the faculty that I talked to never even mentioned it. It was clear we had a foreign currency issue because the dollar was, the exchange rates were fixed at the time. But the system was under stress because we were running big current account deficits. We studied that in college. People explained that this was a problem, but it wouldn't seem to be an emergency. It had to be dealt with at some point. The basic, as I think back, the basic perspective of the faculty teaching econ in those days was that this new development of Keynesian spending and the monetary policy that went with it was counter-cyclical and had been very successful from the end of the Korean War until I got to school. It had been successful in smoothing out the cycles, and we had good economic growth. The 60s was a good decade, but by the end of the decade, the Johnson's guns and butter policy was beginning to put stress on. We're starting to see acceleration of inflation, and my professor said, "Of course, we got too big a budget deficits. You're sort of violating the game plan for the Keynesian stimulus and contraction." In those days, it was understood that when inflation began to pick up, you were supposed to tighten money supply, cut back on government spending. That was the policy that they were recommending. So when Nixon made the speech, I was barely aware of it. I was not at the time employed. 2 years later, I ended up in the investment business, in the bond business in New York. And like John, people felt sorry for me. He just didn't want to do that. And even later in my getting out of business school in 1979, I went to work for an equity management firm. I mean, that's absolute suicide for career-wise. So again, it was very unpopular. But the 70s, and we'll obviously talk a lot about that, I learned some lessons from that I think are applicable today. But at the moment this happened, I was yet to be employed.
Well, what's really interesting about then versus now is there are so many really strong similarities between what we're seeing today and what was starting to brew following that Nixon shock, specifically inflation. I mean, we've seen the CPI soar to almost 5.5% just in the span of a few months. And it even seems like the nature of the inflation is very similar to how it started back then, in terms of being primarily a supply side phenomenon, an issue of supply. There was, I guess back then there was a food shock initially that sent food prices soaring, and then that followed on with the oil embargo that sent oil prices up. And today, of course, we're seeing, the inflation really confined to some areas where there are supply issues. But I guess the question then is, back then, obviously, it eventually bled out. And maybe, I don't know if Nixon described it or as people described it as transitory back then, only to discover down the line that it was anything but. But that's certainly where we are today, is this feeling that, well, it's just isolated to a few things, it's transitory. Can you all talk a little bit about the similarities or differences you see in terms of the nature of the inflation that we're experiencing today versus what we went through back then?
Yeah.
John, do you have some thoughts on that one?
Yeah, I would say a big difference today versus then is that interest rates are suppressed. Their nominal rates are very low, as we all know. In the 70s, I think rates were rising, and Arthur Burns was told by Nixon not to let them go up too much, and he wanted to get reelected, which is the whole point of the speech. This was totally political.
Yeah.
Nixon didn't understand gold, didn't care about it, so the dynamics are very similar. Is basically there was an attempt to suppress inflation, interest rates. And back then you had wage and price controls. They're not dumb enough today to try to do that so far. Another big difference is that in the 1970s, government was not that big a part of the economy, but today the government is 22% of the economy. And we'll talk about this later, but transfer payments are a big percentage of personal consumption expenditures. So big difference there as well. And Bill probably has a couple of other thoughts on that.
Yeah, I think there are some parallels. I think certainly, and I remember distinctly as I started in the bond business and people were thinking about interest rates, and the idea was that these forces, these one-time forces, were transitory, and everybody was absolutely certain. I mean, everybody that inflation was temporary. And we would go back, and this wasn't going to go away, but the higher levels were going to go away, and instead they kept going up. I remember distinctly going to the supermarket in the early 70s and seeing that there was no meat in the meat department. That was absolutely directly a function of Nixon's wage and price controls. And so we began to run out of things, and so you had to ration meat, you had to ration other things, and so Nixon began to unwind, the administration began to unwind those price controls, and that initial unwinding created a surge in inflation. Yeah.
And wages as well.
And yeah, we'll come to wages in a minute. Of course, in the 70s, the unions were much stronger. So we'll come back to that point, which I think is an interesting difference today. But I remember as a young guy in a bond department, rising interest rates, of course, were terrible for us. We were losing money as rates rose. So it was important to try to get some idea of what was happening. And we had this, I guess it was the 74, you can see the inflation rate started to surge, and it really surged into the late 70s. I mean, into the mid 70s, partly because of the taking off the wage and price controls, which had held it artificially low, but also because of the Arab oil embargo in the later part of that, 73, I guess it was the Arab war. And so, again, we'll come back to those specific points of why inflation surged. But I remember it was so similar to today that the marketplace, all of us were certain it was temporary.
It was transitory. I mean, I think that's really the thing that stands out today is if you look at the surge we've seen in the CPI and overlay that with the 10-year bond yield, it's just, you've really never seen a disconnect like that. And it speaks to the success the Fed has had in selling this transitory narrative. I think it's also evident in gold, which you'd think, given what's transformed in terms of the monetary fiscal policy and the increase in the inflation measures, that gold would be much higher. But clearly, people are betting, as they did then, I guess, that this really will prove transitory. And I guess the interesting thing about that is the interest rate valve, which finally did, serve as a check back then, is being artificially manipulated today. So it's kind of the most, inflation's the most important similarity, but the interest rate dynamic is clearly the most important difference
That's a huge
today.
Difference, yeah.
And it's just strictly a function of this dramatically different approach to monetary policy, where the Fed is just, going to sit there and suppress interest rates, which eventually they couldn't do. At some point they gave up on, I guess, back then, John, but now there's an infinite runway for them to suppress interest rates.
Don't know the limits of what they're, they've bought more tips than have been issued. And, so people look at tips and say, well, there's no inflation.
Right.
Because look at the tip spread.
Yeah. It's a broken signal.
Can you use that as a valid, so all of these indicators that used to work are being, in one way or another, controlled. The CPI itself is nonsensical, and yet I see a lot of very smart economists and who confine their analysis to parsing the components of the CPI, as if that were the thing. Inflation
they probably
is psychological.
make forecasts to the nearest decimal point too.
Exactly. So inflation is 100% psychological.
Yeah.
And it's how human behavior adapts to rising prices, and it's self-reinforcing. Yeah. I know Bill has some eloquent thoughts on that, but that to me is what is not captured in the CPI.
Yeah.
I think, as I think back over that period and my experience in that period, I learned a painful lesson as in being in the bond business. I learned that the experience of inflation, not the CPI, whatever the way it's measured by whomever, but the actual experience of inflation changes people's behavior.
Sure.
And that means people will accelerate their spending. They have dollars sitting in the bank, and they start to expect things to cost more next month, next year, whatever. So they buy it today as opposed to wait, and that's a change in behavior. That would probably affect the velocity of money. Companies, the management start to hoard raw materials for the same reason. They don't want to pay more tomorrow, so they buy it today. There are all kind of other consequences, but the change in behavior that happens once people actually experience inflation, this is not a theoretical idea. That change in behavior, economists refer to, and I think this is sort of one of the main points I think we need to talk about, as inflationary expectations. And they think, people think you can measure them, maybe you can. The measurements that we see are up substantially, but I think you will begin to see behavior, you already begin to see people behaving somewhat differently, spending more, saving less, certainly with these low interest rates. And that was one of the real key takeaways, that inflation begets more inflation.
Right, and we've seen that vividly in Japan, in the other direction. But the little tricky thing about it now is that obviously the consumer inflation expectations numbers, as you noted, have gone up a lot. So whatever the tips indicator, which is broken, or whatever investors might actually believe about transitory, consumers aren't buying it. They see the inflation and they expect it to continue to go higher. The problem is right now, their wages aren't keeping up with that inflation. So their ability to start to stockpile things is limited, isn't it? Or how do you see that playing out in this narrative?
Well, I think the wage thing is quite interesting. The wages have yet to go up, but I'm pretty confident that this is the next leg of inflation, because everywhere I look, there's a labor shortage, and I mean everywhere. And you take the unemployment number, the unemployed number, and you think about the number of people that are getting federal assistance, the number of people that are still unemployed from COVID, there should be plenty of slack in the labor market. And everywhere I go, I experience labor shortage. I got a haircut down in Edwards a month ago, I had to wait an hour to get to the barber. The barber shop was so full. And it was interesting because they used to have 3, now they only have 2. And I said, well, when was the last time you raised your prices on haircuts? Oh, years ago. Well, that's coming. That hasn't happened yet. But there's a shortage. Every place we go, there's a shortage of labor. Particularly lower end labor is in very short supply. And so we see this over and over again anecdotally, and you're also seeing it in the surveys of companies and so on. They can't find workers. So that's. I'll go back and make another inference about inflation, and that is my experience of inflation is that shortages and inflation are the same thing. And when you have shortages as an issue, as opposed to some other issue, people again change their behavior. If I can't buy gasoline, shortage of gasoline and rationing gasoline, I don't care so much about what I pay. I really want to be able to get it. So I'm not as price sensitive. And the other thing is when there's shortages, that implies prices are too low. So I think certainly in the labor market, we're about to see a significant increase in wages. We're starting to see it, and managements that I talk to and managements that I know about are putting in much higher wage numbers. We're starting to see it even here in this area. Wages are going to go up a lot, I think, in the near future.
So we'll put you squarely in the secular inflationist camp in that debate between inflation or deflation. Where do you sit on that one, John? It's a raging debate right now.
It is a raging debate, and smart people on both sides. I think the argument that which you alluded to, which is that because prices have gone up so much and wages have failed to keep pace, could argue for a big economic slowdown. And if that were to take place, you can be sure that this administration and whatever administration is to come is going to see to it that the transfer payments are and it's not the unions anymore.
Yeah.
It's the government's willingness to. We saw the extension of rent forbearance, maybe forgiveness of student loans. It's kind of the same thing as the union demands of the 1970s, but in a different form.
Yeah.
So I would say yes, there's a good chance that there will be an economic slowdown because of what you mentioned. But should that happen, I think the reaction function of government policy will be very supportive of higher wages and higher transfer payments. And again, it's behavior. It's human behavior.
Yeah.
Why aren't people working? Because they haven't had to for a long time.
Right.
Yeah, I think that what my point is about the labor market is that in the 1970s, the argument is that the labor unions were sort of a flywheel that kept inflation turning along with their wage negotiations. We don't have labor unions that strong anymore, so therefore that's not an issue. But when I went to a restaurant in Western Massachusetts 3 weeks ago, there was a sign that says, "No one wants to work," outside the restaurant. Please be patient with the staff that did show up. Yeah. So the market is the structural market has changed, so that we have the labor force participation has fallen off a cliff. So I'm going to argue that there's been a structural change in the labor market that's putting upward pressure on wages, and that's soon to happen.
Well, whether it's because people are, there's this mismatch between labor and the jobs, or they're just getting paid to sit at home. I mean, it seems clear that, as you mentioned, John, if there is a slowdown in demand and spending, they're just going to use it as a rationale to do another round of stimulus, which is, I've sort of snickered recently in commentaries to my clients that the inflation is going to be a rationale for more stimulus, which will fuel more inflation because they'll keep handing people money. I mean, when you look at consumer spending versus the delivery of checks to the mailbox, it's perfect. When they stopped getting checks at the end of last year, at the end of the Trump administration, spending fell off a cliff, and then when the checks went out in January, it soared right back, and then it collapsed until they passed the bill in March, and so we keep going up and down. And the growth is only as good right now as the sugar high. But I think that factor, that the difference between the monetary and fiscal policy today is probably the strongest single argument for the secular inflation case, which, you know, folks like me would couch against the forces of debt and demographics, which are major deflationary forces. And I'm wrestling to figure out how that plays out. But
well, deflation basically is the deflationary forces are huge today, and the reason for that is the high level of debt in the public and private sector. And I know we have a chart that would show that. So we're stuck in this world where interest rates cannot go up without having very adverse effects in the economy. And the offset to that is the government's willingness, in fact, the expectation that the government will come to the rescue. And that cycle, to me, is the pulling between deflation and inflation. They're very closely related, and we're at a place where I think the potential for further currency debasement is the only way out.
Absolutely.
And again, so I'd love to get away from this idea that the CPI is really a metric that has any value at all in terms of what's going on with inflation. It's behavior in the marketplace. What we just showed is the workforce participation. That's the labor shortage, and the correction for that is higher wages, and it will flow through. It will eventually be seen by the CPI, but probably too late in the game.
Well, what I wrestle with on the inability for us to withstand any increase in interest rates is that the Fed can control the Treasury curve, unless or until they start going out and buying private debt, as they did.
They did.
But if they close that down, if they restart that facility and actually utilize it, right now you're seeing corporate bond yields actually start to edge higher. So it's going to be very interesting to see, how much control the Fed has. It's one topic we've also discussed is this unswerving faith in the Fed and their ability to somehow steer markets and make sure that we don't have any kind of, all hell doesn't break loose. And it's evident in, I think, gold and, the sort of quiescent nature of the markets, and of course the soaring performance of the stock market.
Well, I want to before we start getting into today too much, I don't want to leave the 70s just yet, because I think I'm curious about John's experience. So there was a speculative episode in the early 70s, and you were participating. You were helping it along.
I was fanning the flames.
You were fanning the flames, and so you have a speculative episode at the beginning of that acceleration of inflation. And we've had this massive episode yet again since the 2008 experience. And I don't know, John, do you want to sort of compare the two to then versus now in the speculation in equities?
Sure. I mean, we had in those days something called the Nifty 50, which again were stocks priced for perfection. And my job as an analyst was to explain to people why a particular stock like Avon Products should trade, MGIC is another one I remember, should deserve to sell at that, and their earnings would grow, ad infinitum, and therefore higher prices would be expected. That was the Nifty 50. But if you look at the chart of market cap to GDP, you can barely see the effect that I and my cohorts had relative to where we are today. So, I mean, I feel quite inadequate in retrospect.
Hey, you gave it your best effort.
I gave it my best, and it just doesn't even register on a chart of market cap to GDP. So now you have all forces, the Federal Reserve being first and foremost among them, the financial media being right there with them in terms of thought control, and I think that's the best explanation I can think of for why market cap to GDP is today, I think it's 80% higher than it was in 07, 08, before the housing crisis.
Well, that creates a real problem for the Fed, because if we were to revert to mean valuations...
How do we undo this?
Yeah. I mean, that's why I think they're so desperate to just make sure they keep that bubble inflated. And I guess the question is, how long can they keep doing that?
Well, and the relationship between the Fed's behavior and the belief that the Fed has the markets back is so symbiotic. And once that cracks, then the repercussions are very widespread. To me, that's just thinking about gold. What's missing is the idea that basically, if you play it in the middle of the fairway, you're safe. And once that complacency is unnerved, then people will look for something, a different strategy, which is where gold would come in.
I don't know about you, but I'm just shocked that we haven't gotten to that point yet. I thought for sure after they came in guns a-blazing after the global financial crisis, it started QE and then had to do QE2 and QE3. Remember when people thought QE was transitory?
Yeah.
And then it kept coming back?
Yeah.
You would have thought that each one of those moves would have dented the credibility of the Fed. And instead, it seems like it's even more resolute today than it ever was before.
Well, you have to, I guess you have to, we've had the same experience. It's just shocked. Month after year, these things have gone bigger and bigger and bigger. Yeah. I guess what's happened is that we have this massive stimulus from the Fed and now from the Treasury and the Fed, and there's up until now there have really been no adverse consequences. So there hasn't been any inflation. There hasn't been
Right.
This is a magical world, which I think is unsustainable. But there've been no bad consequences, and the prices go up. And so, what's wrong with doing this?
Well, this is the perfect segue back. Return to the conversation about fiat money, because we all agree, whether we're in secular inflation or deflation camps, that the Fed has to keep doing QE, both to keep interest rates suppressed and also to keep the stock market at these nosebleed valuations, because God forbid they revert to the mean and then it's lights out for the entire economy and every pension, et cetera, et cetera. So that being the case, the question is, what causes this fiat money regime to finally jump the shark? Again, I would have thought that we would have pushed the limits already, but it's just hard. I guess part of the issue is that this old cleanest dirty shirt argument, what's the alternative to the dollar right now? I mean, you're not going to buy euros.
I want to go back to the 70s because this was a very important, this is an important difference with today, and it goes to your point. And again, I was a participant in the bond market, and I watched the central bank raise interest rates year after year, and it was painful for us, but we thought, this is going to really slow down the economy. Let's look at what we're doing. The interest rates got to very high levels, on nominal levels, at least historically. And shockingly, it didn't seem to matter. And of course, what was going on is this distinction that we really have to talk about today, which is real versus nominal interest rates. So we were all focused on nominal interest rates, which were rising to levels that almost never seen before, thinking that was very contractionary. And yet, inflation was accelerating to such a level that real yields went actually quite negative. So it had, at worst, it had no effect, maybe it wasn't an effect at all. Rising rates were unaffected or ineffective because the real yields went down. This happened in the mid-'70s, and then again at the late '70s, until one Paul Volcker became the central bank. So you had negative real yields on a substantial level, even with some of the highest nominal rates we'd ever seen. And until you got real yields to some of the highest levels seen, thanks to Mr. Volcker, that began to make a real difference. And I remember Volcker's press conference on a Saturday night, October '79. I watched it. He has a press conference on a Saturday night. in which he announced he was not going to raise, he's not going to focus on watching interest rates anymore. He's now going to focus on the money supply. And then, by the way, that'll make interest rates, he called them volatile. Well, the next Monday, rates went crazy, went up. And for the next couple of years, rates went up to where the short rates got up to 20%. And that was enough. The real interest rate became very punitive and slowed everything down, and that finally broke the back. But I think today one of the critical issues is what's happening to real interest rates today. And my thesis is that obviously, as we're finally seeing inflation for the first time in years, real inflation, that the real yield has gone very negative. They're not even raising rates today. The real rates are going very negative, and that's going to stimulate the economy, maybe like as much as Volcker's negative rates contracted it in the early 80s.
But that being the case, the question still begs, where does it end? If we're going to artificially cap interest rates and continue to pass stimulus bills. And, we're not alone. We've got Europe, UK, Japan all doing the same thing. Aren't we pushing this whole fiat money experiment sort of to the brink at this point?
Pushing the envelope for sure. And what will bring it to its knees, I think, is inflation. That is not going to go away. And it just astonishes me that there's so much faith in the Fed that, when and the market flinches every time they say taper, that they talk about it. But let's remember 2018 when they tried to taper, the market went crazy. And I think the same thing. So the Fed is essentially hostage to the financial markets. The carnage would be so great if they actually did something, which I don't think they will, that, and they know it, I think they know it, that they're not going to do anything. And that means that the inflation that we're talking about, which is really just getting started, is going to carry on much longer and do a lot more damage. And right now we're in the party phase of inflation because the markets are great. But the hangover, it has yet to come, and if I knew when that would be, I'd be, but I'm not.
You'd be taking aspirin right now.
I'd be taking something. But that, I think, that is yet to come.
Yeah, I completely agree. I think the end game here ultimately has got to be inflation, and I think it's inflation that becomes just really painful. My thesis is that because we're starting to see inflation, you're going to start to see these behavioral changes, inflationary expectations rising. At the same time that, unlike the 70s, you've got interest rates at virtually zero, and they're going to stay there, I agree. And that means that real rates are going to go very negative. And how much and how far, it's hard to know. But very negative real interest rates, I think, are going to stimulate more spending, more inflation. We think we're in a different paradigm. We think we've shifted over with the acceleration of inflation. We're now in a different world than we've been in the last 30 or 40 years. And ultimately, not right away, ultimately, when people begin to realize that this isn't transitory, it's going to be extremely painful. Because then what's the Fed going to do? They're trapped.
Right.
And so I don't know, but it's going to be a real problem.
I keep wondering where our foreign creditors are in this whole debate.
They're in the same game. I mean, they have fiat currencies, and so all they care about is relative value of one currency to another. But I would think, and Bill probably has his own thoughts, but I think that inflation will show up everywhere in all countries. So it won't just be uniquely an American problem. I think the whole, fiat monetary system is shared by all countries, all central banks, and therefore I think they're all subject to this great risk of inflation, which nobody is paying attention to right now.
Yeah, I agree in general, and a couple of points. I agree with John. This is going to be international in scope. I want to come back to give some examples of why I think that's going to be. But I will take one difference. When we say all countries are in this boat, all developed countries are
Yes,
in this boat,
the
and it's
emerging
the
world.
it's the
The
banana
creditors.
republics of the world, which are really not banana republics.
They're the creditors.
Well, some are creditors, but these are countries that still follow orthodox economics. They have policies that post-COVID make economic sense. And by the way, the stocks are incredibly cheap. So you have this kind of valuation of U.S. stocks. You're seeing exactly the antithesis in the rest of the world, emerging world, where we're very active. And I think at some point, those currencies will do better than the developed world currencies for just the reasons we've been talking about.
Well, China's currency has been strengthening steadily throughout this. So they're blazing a different path, and they're one of our most important global creditors, or were. They've obviously been turning tail for quite a while now, but they clearly have a very different agenda. They've mapped out a very different course than the G3 developed world has.
One of the points that I wanted to make about this being an international phenomenon is that the supply of all kind of things, natural resources and other things, there's been a lack of investment in this stuff for many, many years. There's a shortage of showing up across the board. We like the energy space because of the green lobby has become so powerful. Many energy companies are just in the process of liquidating. So we think there's going to be we think it's developing a big energy shortage, but this is true across the board. And also, there are other shortages as well. I was reading this morning, the shipping industry is in real shortage. So there's a shortage of containers. There's a shortage of ships, the ships are on order, but they won't be here for another couple of years. And the lack of investment in ports is now a big deal. The Financial Times this morning reports that there are 340 container ships stuck outside of ports because they just don't have the capacity. So all of that, these kinds of things are international, and they are going to push up prices for some time.
Well, I'm glad you brought up resources particularly, because that gets immediately back to this dollar question. Because all those global commodity producers, most of them are still receiving payment in dollars, which are getting worth less every day. So at what point do they say, why are we clinging to this dollar standard, particularly when our marginal customer isn't the US anymore? It's China and it's the developing world, et cetera. I mean, does that play into your
I think I remember back in the 70s that the Saudis had exactly this objection. Why are we selling oil in dollars when the dollar's going down? I think there was some effort to make them, they were going to get paid in gold. And I think ultimately that's kind of what brought Volcker in, because the Saudis were very unhappy. And I think you're right. At some point, the international producers of commodities in short supply, but what currency are they going to get paid?
Well, that's the question. That's why we come back to what's coming next. We've had 50 years of this fiat money era. And as I said, it's the only era most of us, and I would imagine most of the audience, has ever known. So it's really hard to fathom what the next era looks like. How do you envision the next currency regime?
Well, first, you're already seeing the Chinese, Russians, many Middle Eastern producers are taking payment in other than U.S. dollars. So the dollar still dominates world trade. That's not going to change immediately, but it's already beginning. What a new arrangement would be, I don't know. I think it probably will still have dollar as a big component. Probably RMB would be a big component. I think that's just a matter of guesswork. I would be surprised if gold were given more than a cameo role in a new system, if that were to come about, just because it's so problematic, because it enforces, if you really adhered to it, the disciplines would be politically unacceptable. I mean, that's every time they've weakened the gold standard, going back for the last century, it's been because gold was too restrictive on government spending and the kinds of monkey business the Fed is doing now in terms of keeping interest rates below market. So that to me is a speculation. What I would say on behalf of gold is that it offers protection against all of this. It doesn't have to be part of a financial system or a monetary arrangement to provide protection against what's going, the debasement that has to take place.
It gets you from here to there.
It gets you from here to there.
Yeah.
And the correlation, I think, between gold and real interest rates is pretty solid, right?
Yes, I think it's 0.94.
So
which is
negative
pretty good.
real interest
Hard
rates.
to beat that.
It's hard to beat that.
So the negative real interest rates that I'm foreseeing
Right, should also
should
be
be really good for gold.
Yeah.
It hasn't been yet. So
Do you think part of that is this new hot thing, crypto? And that people say, why do I need to own gold? That's for, people who are around in the 70s.
Guys like us.
All three
Yeah,
of
guys
us.
like us.
That includes me. I may have been in diapers, but I was around.
Yeah.
Crypto is obviously the new thing, the new gold. How do you see that?
well, we own both. I don't know that you have to make a distinction between one and the other. We view Bitcoin as digital gold. We've actually sold a fair amount of it not so long ago. And I certainly think Bitcoin has a lot of issues and questions and Tether and other stuff. But we view Bitcoin as digital gold. I think to the larger issue of what replaces fiat currency, it's very hard to know because I think the question itself demonstrates how bad things will have to get before this actually happens.
Right,
And
it's not going to be
It's not
voluntary.
going to happen voluntarily.
Right.
It's gonna be,
Yeah,
it's
exactly
gonna
the
be-
point. So things are going to have to get really bad before the world and the public and certainly the politicians accept some kind of a stronger standard, whether it's based on metals or Bitcoin or whatever.
Basket.
I don't see that in the near future, and therefore I think things are going to get really bad. I mean, and this goes to my inflation argument that inflation's going to have to get really bad before people want to change the currency.
Yeah. Well, it certainly seems like there is no end in sight to the uber accommodative monetary and fiscal policy that we've got going.
There's another alternative I think which we need to mention. So we can continue down this road, and as inflation begins to get worse, Russell Napier has a sort of an adjustment that he makes or talks about, and that is basically capital controls. So there are government controls, and whether it's wage and price controls or capital controls, who can borrow money, or you have to lend money to the government. There's all kind of things which we haven't seen since the 70s and 60s and 70s. And that might temper the inflation fires temporarily or for a while.
Not if it's the wage thing, unless they do wage controls.
Well, they can do that. So, and who knows? The political environment, the other thing is clear today, the political environment is so much more polarized and so much more disparate in the different ways that people think about things. With one universally true for both political sides, and that is that the constituency for hard money has disappeared completely in the political world. Republicans and Democrats, they spend like crazy. There's no real worry about deficits. I don't hear people talking about deficits, and they also support this radical monetary policy. Unlike in the 70s, where conservatives were more focused on hard money than certainly not today.
The irony, though, is that they do all this under the guise of helping the low-income or middle-class consumer, and ultimately, of course, those are the ones who are most disenfranchised.
Most hurt.
And then this wealth gap just continues to widen. But anyway, it's been a pleasure speaking with you gentlemen about this. As John so cleverly said when we sat down, this is the anti-Jackson Hole. So we're going to turn it over to Jay and see if he comes up with any great new euphemisms for transitory, I guess. Is that what we're waiting for?
Right. My expectations are low. High for new euphemisms, but any change of course, forget it.
Great. Well, thank you again.
Thank you very much, Stephanie.
And thank you again for joining us for this conversation. We'll catch you on the next side. Buy a wheelbarrow.